Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, markets have been noisy this week. Tech sold off sharply, energy and banks suddenly look like leaders again, and yet volatility hasn't really spiked. What's the market actually trying to tell us?
I think the key word is rotation, not panic. For the first time in a long while, leadership is wobbling. Technology, the unquestioned engine of the last cycle, looks tired. Not broken, but fatigued. And when the leaders start to tire, markets don't collapse immediately. They rearrange themselves. Take what happened midweek. Microsoft fell around 10% in a single session, its biggest drop since March 2020. That's not a macro shock. That's a valuation and expectations shock. And it matters because Microsoft isn't some marginal player. It's a proxy for the entire AI capex narrative.
So this wasn't about bad earnings?
No, quite the opposite. The results themselves were strong. Revenues up, cloud growth impressive, Azure still compounding at eye-watering rates. But markets fixated on one thing: capital intensity. CapEx jumped sharply, into the mid-30 billions in a single quarter. And it's not coming back down anytime soon. Long-dated GPU contracts, massive data center buildouts, power infrastructure, cooling, land. This is physical investment on a scale we haven't really seen since the telecom boom. The question investors are now asking is subtle, but crucial. At what point does AI stop being a high-margin software story and start behaving like heavy industry? And that's why we're seeing dispersion. Meta can rally because the market believes its spend is defensive and strategic. Others aren't getting that benefit of the doubt. This is the market growing up.
And while tech is wobbling, old economy sectors suddenly look relevant again.
Exactly. And that's not a coincidence. Banks and energy have quietly taken the baton over the last few sessions. A steeper yield curve helps bank profitability almost mechanically. Net interest margins expand, balance sheets look healthier, and suddenly a sector that's been left for dead starts to matter again. Energy is even more telling. Oil prices are sitting near multi-month highs, and while geopolitics is part of that, particularly Middle East risk, this isn't just about headlines. Supply remains constrained, outages persist, and producers are far more disciplined than the models assume. Yes, the IEA and EIA still talk about surpluses. Producers talk about tightness. Prices are telling you who's closer to the truth right now. Oil equities are acting like a sector in breakout mode, not a late cycle trade.
And yet, despite all this, tech selling off, oil pushing higher, geopolitics bubbling, volatility hasn't really reacted.
That's one of the most important tells of the week. The VIX is boring. Equity volatility is entirely unremarkable. So while markets feel noisy, structurally, they're not stressed. This isn't 2018, it isn't 2020, it isn't even 2022. It's a rotation happening within a functioning system. That tells us positioning is adjusting, not being forcibly unwound.
Let's bring in the Fed. They met this week and the message felt deliberately dull.
Deliberately dull is exactly right. The Fed held rates steady, as expected, but the language shift mattered. Employment risk and inflation risk are now being treated as equals. Growth was upgraded. Unemployment is leveling out, not deteriorating. In other words, no emergency. Chair Powell went out of his way to reinforce patience. The Fed still expects inflation to drift lower over time. They still envisage cuts eventually, but they're not interested in validating market fantasies about rapid or preemptive easing. And importantly, Powell stressed Fed independence, brushing aside political noise and legal theater. The message was calm, controlled, and very clear. Policy is easy enough. We have time. Convince us with data.
So the idea of aggressive rate cuts this year is fading?
It is, slowly but persistently. Markets still price a couple of cuts by year end, but conviction is eroding, and we're seeing that show up in less obvious places. Credit conditions are tightening at the margin, not breaking, tightening. Financing costs are creeping up. Haircuts are widening. Balance sheet is being rationed more carefully. It's not a crisis, but the easy phase is behind us. And when you combine that with higher oil prices, firmer metals, and massive AI-related capex, you get a world where capital is no longer free.
That's it for this week. Stay tuned for more insights next time.